Well, let's focus on the defense space then. We have Sachin Agarwal, the chairman and managing director at PTC Industries, who joins us on the show. Well, we'll be focusing on three main points: the company's defense sector opportunity, the commissioning of the new facilities and Capex, and finally, we'll also be keeping an eye out on the order flow inflow expectations for the remainder of this year. So that's going to be all the top points that we're looking at. Well, let's get in the management then this morning, who's joining in on the show. Hi, Mr. Agarwal. Good morning. Thanks a lot for joining in. Well, things seem to be coming together for you. And, if you look at it on a trailing basis, your stock looks rather expensive. But you have talked about big prospects in the coming years, and the street seems to be buying into that. I think earlier you were guiding for around 750 crores for FY26. You stick to that?
Yeah, as I mentioned last time, we said that we will be doubling our revenue from the previous year for this year. So we're still on track for that. So a very good morning. Yes, I think the prospects are very, very good. We already have an order book in excess of 700 crores to fulfill our targets for this year and for next year as well. The order book is building up very fast. As you could have seen, the new press release related to BrahMos getting in excess of 100 crores of order, not just from the domestic sources, but also from the foreign OEMs as well. A lot of long-term agreements and orders are in pipeline, which we envisage to be in place in the next 6 months or so. The capacity build-up and the execution of our new facility is also going on a very, very fast pace.
Okay, all right. Mr. Agarwal, let me push you a little bit more then. 750 crores of revenues. What about margins? Earlier, you were talking about, I think, margins in excess of around 20%. The start of the year has been soft. Maybe a couple of one-offs have impacted it. But on an average for the year, what should margins look like?
Yes, as I said, doubling the revenue, so that's not 750 crores, that's in closer to 700 crores.
700 crores, okay.
And margins are going to be on the same line as what happened last year. Overall margin in excess of 20%, closer to 25% EBITDA margins. Now, if we go further beyond as the pipelines are built up and the revenues increase, this EBITDA margins are going to increase over the next 5 years to be in excess of 35% blended margin.
So FY26 margins, 20 to 25%, maybe closer to 25%.
That's right.
But in 5 years, it should go up to 35%.
That's right, or in excess of that.
Or in excess of that. Your order book, you said, currently is 700 crore rupees?
Yes,
what is the expected order inflow for FY26?
So we're expecting from domestic sources an additional order book of domestic requirement of excess of around 200 crores. But foreign order book is going to start building up next year, which will be, including long-term agreements, will be quite sizable, I would say, in excess of 1,000 crores or more than that. Depends on how long a term for the order book we look at.
And you also spoke about how the companies, there is some capacity expansion underway, which supports your target of doubling revenues and the growth outlook going forward. By how much does your capacity go up? How much have you spent so far? How much more on the anvil?
So we are currently investing in what is called our strategic materials technology complex, where a full end-to-end solution manufacturing, right from materials manufacturing in titanium and superalloys, to components, to machined parts, to forgings, rolled parts, raw products is being set up. This is a massive capacity and will be very, very unique in the world. And that is where the foreign OEMs have a massive interest in our facility. Even the new AMCA engine, if you can imagine, all these aero engines have almost 80% of the products which are material which is going in various forms, either in titanium or superalloys. And we are the only ones in India who have the capability to manufacture all these materials in various forms. So going forward, I think the margins as well as the top line is going to grow. The titanium material facility is a 6,000-ton facility. There is a super alloy facility. Then we have super alloy and titanium casting facility combined together in close to 600, 700 crores, 600, 700 tons capacity. Forging products. So there are multiple projects. So the capacities for them are different. That's why we are foreseeing that, as I said, we are doubling the revenue this year. But in the next 5 years or so, the revenue from the previous year will be 10 times the current or the previous year's revenue. So there is all these capacities will be coming into place over the next 1 year, 1.5 years. So once that is in place and certain certification work is completed, then a massive ramp up will happen.
You said your revenues will go up 10x in 5 years?
That's right, yeah.
Okay. So this is from the FY25 revenue of 300 odd crore?
Yes,
okay.
That's right.
So by FY30, we're looking at 3,000 crore of a top line.
3,500 crores.
Oh. All right. Thank you very much for joining in. That's the word coming in from PTC India.